Imagine a single ticking clock, not one that tracks hours, but one that tracks money. For the United States, that clock is currently ticking past $38 trillion. The national debt, that number so vast it loses all meaning, is not just a ledger entry in a spreadsheet. It is a ghost of 1,000 past decisions, a silent weight that presses down on the future of every single person watching this video. Think of the Roman Empire. Brilliant, sprawling, untouchable, yet they were eventually crushed not by a single army, but by the relentless, invisible burden of their own colossal war debts and the cost of maintaining a global position. Or consider Spain, whose golden age was financed by the silver mines of Potosi, only for that endless torrent of wealth to be utterly drowned by the costs of global wars and a government that spent tomorrow's gold today. What if I told you that the forces that shattered those empires, the seductive pull of debt, the political paralysis of spending, and the hidden psychological toll on a massive population are repeating right now, but at a speed and scale that is completely unprecedented? This isn't about doomsaying. This is about recognizing a hidden pattern that echoes through 5,000 years of economic history. A pattern that, once you see it, changes how you view everything from the interest rate on your mortgage to the price of eggs at the grocery store. The United States has a debt problem that is far bigger than just a dollar amount. It's a systemic bomb, and understanding this hidden pattern is the only way to prepare for what comes next. The core topic we must confront is this. The national debt is not merely a political talking point, but an uncontrolled engine of economic change. It is the total accumulation of every annual budget deficit the U.S. government has ever run. Every time the government spends $1 more than it collects in taxes, that difference is borrowed, and that borrowing adds to this giant, growing principle. Why does this $38 plus trillion problem matter to you? Because the cost of servicing this debt, the interest payments, alone is now one of the fastest growing and largest parts of the entire federal budget, exceeding even spending on national defense. This means a larger and larger chunk of your tax money isn't funding schools, roads, or research. It's going straight to investors to pay for yesterday's promises. It traps the government, it warps the economy, and it threatens the entire global financial structure built on the foundation of the American dollar. The hidden truth we're going to uncover is this simple, four-stage debt cycle that has brought down every major empire in history, and how America has now entered its most dangerous, accelerated phase. To grasp the danger, we have to look back, not just decades, but centuries. The story of debt as a weapon of self-destruction begins with the great lie of necessary spending. Most people believe government debt is a simple tool for crisis. You borrow for a war, a pandemic, or a depression, and then you pay it back when things are good. This is the myth. The reality is that debt has always begun with a crisis, but it never leaves. Take the early days of the American Republic. The very first debt was absolutely necessary. The cost of the Revolutionary War. Alexander Hamilton consolidated the $75 million war debts, giving the new nation instant credibility. This was debt as unity. A clear crisis, a clear purpose. But then came the temptation. Once the mechanism exists, why only use it for crisis? Everything changed in the 20th century. World War I saw the U.S. debt jump by $22 billion. World War II rocketed it to $260 billion. These were clear, existential battles. What happened next surprised everyone. Instead of paying it all back, the country grew its way out. The post-war economic boom, the baby boom. The industrial dominance grew the economy so fast that the ratio of debt to gross domestic product actually shrank. This created a deep psychological anchor in the minds of every future leader. You don't actually have to pay it back, you just have to grow. This broke the historical myth of fiscal discipline and ushered in the modern era of permanent, non-stop borrowing, moving the debt from a temporary tool to a foundational pillar. But the history is clear. For every Rome that grew to finance its wars, the day inevitably arrived when the wars were still expensive and the growth was gone. What we are seeing today is the final, disastrous payoff of the psychological permission slip granted decades ago. This brings us to the four-stage cycle of the debt bomb, a pattern that has played out across civilizations. The first stage is crisis-driven borrowing. This is the necessary stage. A major war, a pandemic like COVID, or a 2008-style financial collapse. In these days, borrowing is socially acceptable, even praised. People are scared, the economy is freezing, and politicians are incentivized to spend big and spend fast, often with no real plan for repayment. It feels like an act of survival. Think of the massive, necessary stimulus programs during the pandemic. Debt spikes, but there is popular consensus. This moves us to stage 2, the growth illusion. After the crisis passes, the economy seems to be recovering, but the recovery is artificially inflated by all that new money flooding the system. This post-crisis adrenaline rush convinces politicians and the public that the debt is manageable. They claim the economy will outrun the borrowing, just like post-World War II America did. But crucially, in TSDs, the government stops borrowing only for crises and starts borrowing for structural entitlements for social programs and defense that are now baked into the annual budget. Regardless of the economy, the political will to cut spending or raise taxes vanishes because everything seems fine. Then comes the critical pivot, stage 3, the interest rate trap. Eventually, all that constant borrowing, coupled with the money created to finance it, begins to trigger inflation. To fight inflation, central banks have to raise interest rates. This is the silent killer. When the government has a $38 trillion tab, even a small increase in the interest rate turns into hundreds of billions in new, mandatory interest payments every year. This is the moment the debt becomes self-sustaining. The government has to borrow just to pay the interest on previous borrowing. This trap is psychological too, because high-interest payments crowd out everything else, forcing impossible choices between funding pensions, national security, or healthcare. This cycle of borrowing to pay interest quickly spirals into stage 4. The loss of confidence. This is the Roman coin-clipping moment. It is when creditors, the people and nations who hold us treasury bonds, begin to ask, can they actually pay this back? Or will they just print more money and pay us back in cheaper dollars? They lose confidence. They demand higher interest rates to compensate for the risk. And this, in turn, accelerates stage 3, creating a terrifying feedback loop that can end in a true fiscal crisis. This is a cold historical mechanism. And it's running right now. Let's connect this terrifying mechanism to the present day. We are currently living squarely in the accelerated transition between stage 3 and stage 4. Look at the evidence. We had the crisis-driven borrowing of 2008 and then 2020. That was the injection. We had the growth illusion from 2021 to early 2022, where massive stimulus pumped the economy, and many believed we were fine. Now, we are deep in the interest rate trap. For 2 decades, the government benefited from near-zero interest rates, making $20 trillion in debt feel almost free. But now that the Federal Reserve has raised rates to combat inflation, the interest on the U.S. debt is on track to become the single largest line item in the budget, larger than Social Security or Medicare, within the next decade. This is not a projection. This is locked-in mandatory spending. Every citizen, whether they know it or not, is now paying a massive interest tax to service debts from wars and spending programs that happened years ago. What's different this time is the sheer velocity. In the past, the debt-to-GDP ratio would peak during a war and then be whittled down over a generation. Today, the debt is rising faster during peacetime than it did during most wars. It took the U.S. over 200 years to accumulate its first $1 trillion in debt, but now, $1 trillion is often added in less than a year. The speed is the new factor, driven by an aging population requiring more Medicare and Social Security. Combined with a political system seemingly incapable of slowing the spending, the tension is building, and the quiet part is about to get loud. This moment decides the future. The rise in debt creates a direct, tangible conflict with the public's own finances, something economists call crowding out. Imagine the government enters the loan market every day to borrow billions, needing to attract investors by offering a good rate. This competition for loanable money pushes up the interest rate for everyone else. That means your new car loan costs more. Your business loan, for that small expansion, is more expensive. And that house you wanted is now unaffordable because of the high mortgage rates. The government. The massive debt appetite is quietly slowing the private economy by making capital more expensive for everyone else. This is where everything starts to fall apart, because the higher cost of borrowing for the entire country simultaneously slows the growth that was supposed to save us in stage 2, even more dramatically. The global balance is shifting. For decades, foreign nations like China and Japan were happy to be major creditors, holding vast quantities of U.S. debt because they trusted the stability of the dollar. But as America's debt grows and the interest payments spiral, a cold, hard calculation is being made in capitals around the world. Is this massive debt risk worth holding? When the interest payments exceed the defense budget, what does that say about the nation's priorities? This increased drama and doubt pushed us right up to the edge of the loss of confidence, where a sudden sharp collective decision by creditors to simply demand much higher rates or sell off their holdings could trigger a devastating fiscal crisis. Based on history, 3 major scenarios are possible as this debt crisis escalates. The most optimistic, but perhaps the least likely, is the Great Default by Group. In this scenario, a combination of radical technological breakthroughs, like an explosion in AI-driven productivity and a sudden, sustained surge in immigration, would fuel unprecedented economic growth, a true non-inflationary boom that simply makes the debt small relative to the enormous size of the economy. The government wouldn't pay it off, but the debt-to-GDP ratio would fall safely. This is the Hail Mary option, the historical exception, not the rule. The second, more dangerous possibility is the inflationary erosion. This is the slow, silent default. The government would continue to run massive deficits, funding them by effectively printing money not with paper presses, but through central bank policy. This keeps the immediate cost of borrowing low but relentlessly devalues the currency. The debt is paid off with dollars that are worth less and less. For the average person, this doesn't look like a crisis. It looks like permanent, crippling inflation. Everything gets more expensive. Wages never quite catch up, and the purchasing power of your life savings is gradually eroded. This is the psychological default, where the number $38 trillion is repaid, but every dollar in it has lost 1/3 of its value. Finally, there is the most catastrophic scenario, the fiscal cliff. This is when stage 4 completely breaks down. An external shock, a new war, a major bank failure, or a sudden, unexpected change in creditor demand causes interest rates to spike violently. The government's interest payments become unmanageable instantly. This forces lawmakers to choose between defaulting on bond payments, a never-before-seen event that would crash global markets, enacting immediate, brutal austerity cuts to Social Security, Medicare, and defense, all at once, leading to a deep, painful recession and social instability. The path we take now is being decided by every spending bill, every tax decision, and every day of complacency. The greatest lesson from history's forgotten empires is that they didn't fall to external enemies alone. They imploded under the weight of their own promises. The hidden debt bomb is not merely a technical flaw in a spreadsheet. It is the ultimate expression of a failure of will, a consistent choice by an entire generation to transfer the cost of its current comfort onto the backs of the future. The simple truth is that debt, when allowed to spiral, moves from being a flexible tool of progress to becoming a rigid, inescapable master. It crowds out opportunity, demands impossible choices, and slowly drains the vitality from the core economy through the invisible tax of interests and inflation. The debt is a measure of past consumption, and its consequences are future scarcity. But here is the critical takeaway. You cannot fix what you refuse to acknowledge. Understanding this 4-stage historical pattern crisis, illusion, trap, and loss of confidence is the first, most vital step. The mindshift economy begins when we move past the shock of the number and start asking the deeper, more dangerous questions. Will the U.S. break this centuries-old pattern, or is the $38 trillion debt bomb simply the final chapter of this golden age, already written in red ink? If you found this cinematic journey through economic history and its modern echoes to be a necessary shift in perspective, subscribe to Mindshift Economy. We'll keep tracking the forces that shape your financial reality.